Welcome to the deep dive. Today we're getting into a name you probably know, maybe even use quite a bit. Roblox.
Absolutely. It's this huge digital playground,
Yeah.
right? Millions of users.
Exactly. But when you look under the hood, the financial side of things, it's actually way more complex than you might think.
Definitely not straightforward.
So our mission today is to unpack all of that. We want to cut through the noise, look at Roblox's financial health, where its growth is coming from, and how the market really sees it.
And we're doing that by digging into this comprehensive report. It covers fundamentals, analyst views, market sentiment, the whole lot, specifically on Roblox Core, RBLX.
Right. Uses illustrative data to really profile the company.
Yeah, gives us a solid base to work from.
Okay, let's jump in. The first thing that just leaps out is growth. The report rates it excellent, a perfect 5.0 score. That's huge.
It is, and what's really interesting is how they've managed this transition. They had that, pandemic-fueled hypergrowth, triple digits back in 2020, 2021.
Insane numbers.
Right, but they've shifted from that to something more sustainable, but still really top tier. We're talking projections over 25% annually.
So it's not slowing down, just maturing.
Exactly. Maturing is the perfect word. It's not weakness. It's sustaining momentum at a massive scale.
Okay, so if that hypergrowth phase is done, where's the next wave coming from? What's driving that 25% plus?
Well, the report highlights three key things. First, deepening monetization.
Meaning?
Getting more value per user, increasing that average bookings per daily active user, ABPDAU. They're doing it with better in-game economies, this new ad platform they're building out, e-commerce stuff.
Integrating actual shopping.
Sort of, yeah, within the platform. Second pillar, demographic expansion. The user base is aging up.
Right, I've heard about this. More older users.
Yeah, over 13s are the majority now, and crucially, that group tends to have more disposable income.
Makes sense. And the third?
International growth, especially Asia-Pacific, the APAC region, it's still a huge, relatively untapped market for them.
Okay, that paints a clear picture. But, for a company like Roblox, GAAP revenue, it gets recognized so slowly, doesn't it? How do we get a feel for the momentum right now?
That's a fantastic question. And it really hits on why these platform businesses can be tricky to analyze with just standard metrics.
So what's the better indicator?
Bookings. It's a non-GAAP number, but it's vital here. It basically tracks the value of Robux, their virtual currency that people buy.
So it's like the cash register, what people are spending today.
Exactly. So this JAP revenue gets spread over, say, 28 months. Their estimate of user life bookings give you that immediate snapshot.
And how are bookings looking?
Strong. Q1 2025, for instance, showed a 31% jump year over year. Really reinforces that forward growth outlook.
Okay, 31%, that's solid. Now, you mentioned growth, but the report also hinted at something about profitability maybe turning around from losses to near break even.
Yeah, that's another potentially huge catalyst baked into that growth rating. The projection isn't just top-line growth. It's also seeing a path towards better bottom-line results eventually, moving away from those deep losses.
Okay, hold that thought because, wow, we go from a perfect 5.0 growth score to profitability, and the report calls it poor. A 1.05 out of 5. That's quite the contrast.
It is. It's stark. And that's the central puzzle, isn't it? How can this massive, fast-growing platform consistently report such substantial GAAP net losses?
Is it just the classic tech growth at all costs play?
So that's definitely part of it, yeah. Prioritizing scale and market share. But the sheer size and persistence of these losses, that's what makes investors, especially those focused on traditional metrics, a bit nervous. It's the primary risk.
Let's break it down. Gross profit margin, around 21.5% average, rated weak. That feels really low compared to, say, elite software companies, right?
Yeah.
They're often 75% plus.
They are. But this is where you really need to understand Roblox's model. A huge chunk of their cost of revenue isn't factory costs, it's developer exchange fees.
The money they pay out to the creators on the platform.
Exactly. And those fees aren't just a cost. The report calls them a vital strategic investment. It's the fuel for the whole content engine. It keeps creators building, keeps users engaged.
So cutting that to boost gross margin would be counterproductive.
Hugely. You'd risk killing the golden goose, alienating the very people who make the platform valuable, so that 21.5% isn't directly comparable to a pure software margin.
That's a really important distinction.
Yeah.
Okay, what about operating and net margins then? Are they also skewed or just
Bad?
Or just, deeply negative? Average around -32, -33%, rated very weak.
Ouch. Why so low?
Massive ongoing investment, huge spending on R&D to keep improving the platform, and tons on sales and marketing to drive that global user growth we talked about.
So the money's going into building the future, essentially.
That's the idea. But as a result, your standard return metrics, ROE, ROA, ROIC, they're all deeply negative too. The capital invested hasn't generated GAAP profits yet. Okay. So the GAAP picture looks pretty grim. But you mentioned a paradox earlier, something about cash flow.
Right, this is where it gets fascinating. Despite the terrible GAAP profitability, Roblox actually generates a lot of cash. It's a classic example of that Rule of 40 paradox.
Remind me of the Rule of 40.
Sure, it's a benchmark mainly for SaaS companies. You add the revenue growth rate and the free cash flow margin. If it's over 40%, it suggests a healthy balance between growth and, well, cash generation, even if not GAAP profit.
And Roblox hits that.
Yeah. Using illustrative FY24 numbers, you've got about 26% revenue growth and maybe 15% free cash flow margin. Add them up.
41%, so just over the threshold.
Exactly. Healthy. And the reason for this disconnect, it goes back to bookings. They collect the cash up front when users buy Robux, way before they recognize it as revenue over that 28-month period.
So the cash comes in the door much faster than the profit shows up on the book.
Precisely. It makes them a strong cash generator even with those big GAAP losses.
Okay, so strong cash generation is a big positive. But then the overall financial strength rating in the report is still only weak, 2.30. Why isn't the cash flow saving that score more?
Because it reflects these significant contradictions. You've got this huge pile of cash on one hand, but on the other, the traditional solvency metrics look worrying because of those historical GAAP losses.
Okay, let's dig into those contradictions. Liquidity ratios, for example. Current, quick ratio. How are they?
They've actually declined a bit, now below industry averages. Current ratio around 1.0 to 1.1, quick ratio below 1, suggests things are a bit tighter on the immediate working capital front.
Not great.
No, but again, the company's real flexibility isn't from managing inventory or receivables efficiently. It's from that massive war chest of cash and investments, over $4.5 billion at the start of 2025.
$4.5 billion. Okay, that's a serious cushion. So that helps offset maybe weaker operational liquidity.
Quickly, it buys them a lot of time and options.
So what about the debt side? Solvency.
That's where the traditional view gets really messy. Debt to equity is rated very weak. It looks sky high, super volatile.
Why?
Because those accumulated GAAP losses have often pushed shareholder equity into negative territory. So the ratio becomes mathematically weird and, frankly, not very meaningful.
So ignore debt to equity, basically. What's a better measure?
Debt to assets is probably more telling, and that's actually rated strong around 0.25 recently. It shows debt is only a small part of their total resource base.
Okay, that sounds much better.
It is, but there's still a clear weakness, interest coverage. Because operating profits are negative, they can't cover their interest payments from operations.
So they have to dip into the cash hoard to pay interest on their, $1.8 billion in debt?
Exactly. Underscores that reliance on the cash reserves.
So pulling the financial strength piece together, the cash flow perspective is key.
It really is. The report's cash flow adequacy assessment is much more positive. Despite negative earnings, the business model generates lots of operating cash. The ratio of cash flow from operations to total debt is moderate, around 0.46.
Meaning operating cash could cover almost half the debt in a year.
Theoretically, yeah. And free cash flow to debt is also moderate, though more volatile. That powerful cash generation is the big mitigating factor here. It lets them fund their growth without being in immediate financial danger, despite what some ratios might suggest.
It really is their financial superpower, like you said. Okay, let's shift gears. How do the pros, the analysts, and the wider market feel about all this? Analyst sentiment, first rated, good positive, 4.21. Pretty strong.
Yeah, very strong. And it's largely driven by momentum and estimate revisions. Analysts keep bumping up their forecasts.
Oh, like how?
For FY 2025, in the last 3 months, there were 9 upward earnings per share revisions versus only 2 down. And for revenue, get this, 22 upward revisions, 0 downward.
22 to 0. Wow, that's decisive.
It is. Plus, they've consistently beaten EPS estimates like that Q1 25 beat of 22%. So analysts are clearly becoming more optimistic about the business results.
Okay, optimistic about the business. But the report mentions a point of contention. What's the but?
Valuation. It always comes back to valuation, doesn't
It
it?
usually goes with tech stocks.
Right. The stock had a huge run in 2025, and that rally has actually blown past where many analysts thought it should be. The price now is around $112, but the average target price is only about $89.
So analysts, on average,
Yeah.
see downside, like 20%.
Roughly, yeah. And there's this huge range in targets. Some say $40, some say $125. It's incredibly wide.
Shows the bull-bear debate clearly then.
Absolutely. Bulls are looking at the engagement, the new monetization avenues. Bears, or maybe just cautious analysts, are pointing to the lack of Jap profit now and those high valuation multiples.
Okay, that makes sense. What about the broader market? News, individual investors, traders? How's that sentiment looking? Also, good positive, 3.74, but with divergences.
Yeah, the overall news flow is mostly positive. You see headlines about analyst upgrades, the stock hitting new highs, cool platform developments.
The general buzz is good.
Right. And active traders seem pretty bullish too. Short interest is low, only about 4% of the float.
Meaning not many people are betting against it.
Correct. And the put-call options ratio is 0.66, which suggests more people are buying bullish calls than bearish puts. Technical charts look like an uptrend too.
So traders are optimistic. Where's the divergence you mentioned?
Well, if you look at specific retail investor platforms like StockTwits, sentiment is clearly bullish. But broader analysis, looking across more social media forums using tools like AltIndex, it comes out more neutral, like a 55 out of 100 score.
So maybe the really active traders are bullish, but the wider online chatter is more mixed or cautious?
Seems that way. And another thing that might temper enthusiasm for some is insider selling. While you always need context, the report notes a persistent theme of executives and early investors selling significant amounts of stock.
Right, that always gets noticed.
Yeah.
And you mentioned low short interest, but that doesn't automatically mean everyone's bullish, does it?
Yeah.
Especially for momentum stock.
Excellent point. Yeah, below 4% shows a lack of heavy bearish pressure. But shorting a stock like Roblox that can rip higher is incredibly risky. You could get squeezed badly.
Right.
So that low number might just reflect bears being scared to bet against it as much as it reflects true bullish conviction from everyone else. It's nuanced.
Okay, let's try and tie this all together. The overall fundamental rating from the report combining growth, profitability, financial strength comes out as average moderate, a 3.34 score. What does that final number really tell us?
I think it perfectly captures that profound dichotomy we've been talking about. It's this fundamental split personality.
World-class growth engine on one side.
Right, a perfect 5-star rating there.
Yeah.
But then grappling with these significant gap profitability challenges on the other, a 1-star rating.
And the financial strength is sort of in the middle, dragging it down a bit.
Exactly. That 2-star financial strength rating adds a modest drag. So the final score is this tug of war between amazing growth and weak current profitability.
So what are the core strengths pulling it up toward that average moderate level despite the profit issues?
It has to be that undeniable ongoing growth. They've built this dominant platform, huge network effects, deeply engaged users, and still have clear paths to grow more monetization, international, demographics.
And the cash flow.
And absolutely the cash flow, that powerful cash generation machine passing the rule of 40. It gives them flexibility, validates the core business model, even if gap looks bad. That's a huge strength.
Okay, and the fundamental weakness pulling it down, the Achilles heel.
It's the cost of that growth. Reaching this scale required just massive, sustained investment, leading to those deep, persistent gap losses.
Which messes up the return metrics in the balance sheet on paper.
Right. That lack of operating leverage to date the fact that costs have grown alongside revenue rather than slower, that's the single biggest fundamental weakness identified.
So wrapping it up for someone looking at Roblox, what's the big picture investment thesis here?
It's really a clear bet on the future. You're betting that management can take this incredible scale, this powerful brand, the strong cash flow, and finally translate it into sustainable, long-term profitability.
And the current rating suggests that's plausible, but not a slam dunk yet.
Exactly. Plausible, maybe even likely in the eyes of bulls, but not yet a certainty based purely on the current fundamentals. It's still unfolding.
So there you have it, a deep dive into Roblox's really complex financial picture. Incredible growth, yes. Powerful cash engine, yes. But also facing down these significant profitability hurdles, at least on paper, with a valuation that keeps analysts debating.
It really shows, doesn't it? You have to look beyond just the headlines or the user experience to see the full nuanced story.
Absolutely. Which leads us to a final thought for you to chew on. Given Roblox's unique model collecting cash upfront, prioritizing ecosystem growth, generating cash despite gap losses, how much do traditional financial metrics really capture its value?
Hmm.
Are we maybe using outdated tools to measure these new kinds of platform businesses that focus so heavily on network effects and long-term development over hitting quarterly profit targets? Something to think about.
A very relevant question for many modern companies.
Thanks for diving deep with us today. We hope you feel much more informed about what's really going on beneath the surface at Roblox.